I'm very honored to be here with an esteemed panel. Quickly, a disclosure, Gil Dezer is running a few minutes late. He apologizes. We just figured we'd get started to keep everybody on schedule, and then he'll join us in the next 5 to 10 minutes. Rather than going through my own personal biography of each of these panelists, I'll let them all introduce themselves, and then we'll dig right in, starting with Michael Stern.
Huh? I want to hear the biography. My name is Michael Stern. I'm CEO of JDS Development. We are residential, predominantly developers in a few markets: New York, Miami, Texas, California, and a couple of other places.
Morning. I'm Alex Sapir, and CEO of Sapir Organization, and we are office owner-operators mostly in New York, and residential developers down here as well as New York.
Morning, Martin Nussbaum, founder of Slate Property Group. We are owner-operators in New York City and more recently opened an office in California.
So thank you. So it's interesting. We've seen a tremendous evolution of the South Florida real estate market, and indicative of that is looking at Alex and Michael, both of whom have become recently Florida residents. And so it begs the question as it relates to the entire discipline of real estate development, both in South Florida and the markets that are now being impacted by the U.S. Tax and Jobs Cut Act of 2017. Maybe you could share with us a little bit about your experiences as it relates to tax reform, what it's done in your markets, both in New York or other markets, and then also what your experiences have been in Florida. Maybe start with Michael.
Sure. So we're seeing, because of SALT and a number of other factors, we are seeing a lot of high net worth individuals obviously move to Florida. I don't think that's really anything new. I think what's really changing is now you're seeing companies moving from Connecticut, from New York, Carl Icahn, Barry Sternlichs of the world, moving their entire businesses down south. And I think that's going to be a fundamental game changer. And I think that trend is going to continue because the political environment in New York is challenging right now. And I don't think there's going to be any relief from the onslaught of taxes anytime soon.
Yeah, and to add, I mean, I'd say that, you know, once people come down here and realize that over the last, 5, 10, 15 years, the little village of Miami has really become a real city. And, with companies moving, you kind of have this paradise in the U.S. that's, incredible for your lifestyle, incredible for your wellness. And then at the end of the day, there's business down here. Once high net worth individuals come down here, they get bored. So they got to figure out how to make some money.
I don't have much to add on this topic, so I'm going to leave it.
Although, Michael, from your perspective, Martin, looking at it from your perspective and doing multifamily development in the Northeast, are you seeing any impact as a result of this transfer of wealth coming down from the Northeast? Does it affect your business plan at all, or does it just drive you in a different direction?
My business plan is very heavily related to multifamily rental products. So the reality is the high net worth people that are generally in the high-end condo market that would impact that side of the business. I think it is being impacting New York City a lot. But for my personal business, which is generally sort of, middle to high-end rental product, we haven't seen any impact whatsoever by the movement.
Has it triggered you to look at other markets at all, or are you staying focused on where you're at?
I mean, that isn't the reason. I mean, the legislative change and the regulation that's occurred in New York City, I think, has changed a lot of ways that people invest in. We, too, have moved to Los Angeles. That's the market we decided to pursue.
Because you were looking for a low-tax environment.
Correct. I just want to be on a plane for 5 hours each way. So, but the reality is, I think that New York's gonna have to pivot significantly, and there'll be a huge opportunity. And I think one of the benefits that we see long-term is that people are going away from the market. I don't think we're going to go away from the market. We're going to settle in and sort of sit tight and ride it out.
It's interesting, and it's not a promotion, but it is relevant to the discussion. If you look at the products that both JDS and Sapir are delivering or have almost complete here in South Florida, both of them are catering specifically to that high net worth individual and really offering a level of finishes, a level of quality, a level of amenitization that, from my perspective, in 25 years I've been in this market, I've never seen before. Either of you want to comment on that, just the differentiation?
I mean, I think down here being a developer, because it's Miami and, it's many times a second or third or fourth home, you have to kind of think like a hotelier, and you have to really, think about creating a whole lifestyle program for people down here. And, we went after the high-end market, in Surfside because, a Four Seasons was getting built there, and, just real estate 101, wherever there's a Four Seasons, everything goes up in value around it. So, for us, we wanted to create a really exclusive boutique product, something very exclusive that, catered to a certain lifestyle. And, we have a private spa, tennis courts, and our pools. So, it's really something, that people will enjoy living in, and actually practical amenities. We have a kids' playroom, so, you gotta really work a little harder down here, but the architecture is really important. As the market gets more mature, I think people care about architecture as much as the amenities and everything else. So.
Yeah, that's definitely also consistent with Monad. You have world-renowned Pritzker award-winning architects, and from my perspective, working on 20 some odd projects in South Florida, the level of quality that we're seeing both in the condo space and in the multifamily space, and I think you're both commencing multifamily projects or launching multifamily projects, is really several levels above what we have experienced in this market. And I think that is consistent with what we're seeing now with this transition. And it's not only New York. We're seeing a transition coming from all over the country, people moving to Florida for all kinds of different reasons. And we're at a pretty relevant time now if we talk about taxes and government. How do any of you think that the current election year is going to affect us? Not politically, but are people going to slow down? Is momentum going to change? I know no one has a crystal ball, but what are your thoughts? And last election, obviously, it was molasses. It was concern. What do you expect this year?
Yeah, so I think a couple of things to hit on. First of all, a lot of what you're referencing is just the market here starting to mature and become a real market, especially on the multifamily side, where the multifamily market here used to be sort of a collection of condos that were rented out by a bunch of owners. You're seeing a lot more purpose-built multifamily buildings now, and you're seeing a real multifamily market develop with efficient units, highly amenitized, not dissimilar to some of the large-scale stuff that's been built in other markets that are purpose-built rental product. And as far as the election cycle goes, I think we're at a place where there's kind of legislative gridlock. I think that between the election and impeachment and everything that's going on, you're not going to see much happen on the legislative side. So I don't think it's going to be a terrible factor anytime soon. I think you're just going to see stagnation, which may be okay. I think people kind of need to digest the legislative moves that have happened and understand what they mean. So I don't see it as a big factor right now.
Yeah, and when you look at interest rates, generally heading into an election,
Gil's here.
Interest rates have been much higher. So, it'll be interesting to see. But I definitely think that with rates this low, you're going to see a lot of people trying to figure things out that, maybe wouldn't have tried to figure it out like if we were 6 months ago.
There's been a tremendous amount of multifamily development, proposed development in the country. I don't think it's only Florida. What's driving that? If there's more wealth being created, if the stock market's doing as well as it is, what's driving the multifamily? Is it millennials or is it what is it?
My view on it is the next generation, the younger generation, doesn't view home ownership as the financial foundation of their life in a way that prior generations did. So I think that the renters economy is going to only grow. People don't want to own cars anymore. They Uber. They don't want to commit to a long lease. They go to a co-working space. And I think that trend's just going to continue. It was pounded into our head as kids, buy a home, buy a home, buy a home. That's just not true anymore. So you're going to see more and more multifamily development. Take New York. New York was always a renter's town anyways. And now with what's going on with condo supplies, sentiment, emotion, buying condos, as you know, is mostly psychological anyways. You're just seeing the rental market continue to grow. And to Martin's point, rentals in New York are doing great. Despite whatever you hear out there, it's still the T-bill of real estate is to own multifamily in a stable market like New York. And it's going to continue to do well. It's just the barriers to entry to creating new supply are very high right now.
Gil, thanks for being here. Maybe just a second, introduce yourself, and I'll update you on the panel discussion.
My name is Gil Dezer, president of Dezer Development. Sorry I'm late. Traffic on the highway.
So Gil, we just briefly touched on tax reform, the impact to Florida, the impact to other states, and then we just started talking about the seeming transition to a surge in multifamily development, not only in Florida, but across the country. I know Gil has also been engaged in several of the most significant luxury products in Sunny Isles Beach and elsewhere. So any of those two topics you want to touch on, multifamily development or tax reform and the impact here?
Well, we're seeing the tax reform actually helping us. The big money's moving down to Florida. You've seen it in the news every day. It's actually affected us directly. We've had, as a matter of fact, you can do actually a real case study on this. Carl Icahn moved his office, or announced he's moving his office to Sunny Isles Beach. He took a space over there, and now all of a sudden, we have heard of 5 or 6 sales above $8 million in the area for some of his employees. So they're just starting to come down. So when you have companies like that and people like that moving down here for the tax, and then they're bringing other people, it's a trickle down kind of theory. It goes against what you were just saying about people wanting to rent. I still believe I see that young people want to rent, but there's still always that pride of ownership that will always be for all of us as we get older. I don't sell to young people, so it's not exactly my market. But with the taxes and with what's happening in New York, people moving down here is going to only be a benefit to us.
I think that on the multifamily side, I think the other reason that I think there's such a huge trend forward is that the condo prices have really priced a lot of people out of the ability to own, particularly in the major markets that we're all sort of discussing. But it's very expensive for a young person to be able to afford to buy a condo unit or a single family home. And I think that also is a big driver for the multifamily space.
Well, you also have, as a hedge against the great recession that we all went through, deposit thresholds are much higher today. So it makes that barrier to entry even more challenging for a millennial as age like 23 to 35 or 38. So not all of them or many of them don't have the ability to enter that new condo market, the luxury space. If you look at the profile of the buyers and the renters in the market all across the country, are they changing? Are we seeing the same consistent pattern of buyers in all the products, or is there a shift in the market? Maybe Martin, just looking at your book.
Yeah, again, I'm going to stay on the multifamily side because that's where we sit. But what I can tell you is we're seeing a tremendous amount of people selling homes and then moving into rental apartments right now. I've been watching that trend for the last 2-3 years where, particularly on the higher end rental side, there's a lot of people who are cashing out of their homes, putting some money away. Maybe they're investing in places they think they're going to make more money than their home. And they're moving into apartments where they're downsizing their space and they're putting themselves on specific budgets. They may be budgets of $20,000 a month, but nonetheless a budget of some sort. And that's a huge trend that we're seeing in the higher end side of the rental market.
How much of this boom in multifamily is driven by the financeability of the multifamily product as compared to the condo product? Are developers just fed up with the runway to financing and deciding to go an alternative route? Michael?
I don't think they're necessarily directly related.
No.
And I think you need to bifurcate. It's not one market. There's a very healthy high-end luxury condo market with buyers for Gil's product. We're building high-end condominiums here now, catering to a certain crowd. And then on the multifamily side, it's a younger generation that A, wants flexibility, or B, as you said, doesn't have the deposit money. I mean, on the multifamily side, we're even making it easier by getting rid of a security deposit requirement. There are all these companies that popped up that they don't even have to write a check for a security deposit anymore. So the barrier to entry on the rental side keeps getting lower. Yeah. And on the condo side, maybe it's a little higher, and that's okay. And there's still a very healthy market for high net worth people who want to come here, by the way, not just for the taxes, for the lifestyle as well. I think the lifestyle here, it's inarguable, is very attractive. And I think you need to just bifurcate between those markets. They're both healthy and they're both growing. They're different.
Do you think any of these condo products, multifamily products, ultimately become condo products?
All of them.
Yeah.
Oh, I think right now your road to financing, I think it's a lot easier to get multifamily done today, and as the mantra shifts again, and if you remember back in the 90s, it was 3% down. Clinton was pushing everybody should own a home, and that's kind of what pushed up values and that kind of stuff. But that might come back in some other form, and probably more responsible form. And I think eventually ownership is the way to go, you know? Because if you see most people, I mean, we're talking about today how all these millennials are renting and they prefer to rent versus own. But then you look at the other statistic that most people's, all their equity is what they have in their house. Right. So if we don't start these millennials on starting to buy homes and build that equity, we're going to have a social problem in the next 60 years, you know, where people are just spending without saving. And that's going to be that could be a potential issue.
Yeah, I mean, I spoke on a panel last week about millennials, and there's this concept that millennials are all the things Michael said. They don't want to drive, they don't want to own, but many of them are becoming parents and professionals, and I think that there's a possibility
depends
that
when in
there'll
their
be
life
an evolution.
cycle.
So where they fit into the process. You know, Howard Lorber, our chairman, used to say to me that New York used to be very neighborhood-centric. People would want to live in a particular neighborhood, and that would drive their buying decision, but there seems to be a shift in the market now. People are product-driven. They will go wherever the product that meets their needs is being developed or is most opportunistic for them. How much of that is shifting in all of your markets? Are we finding that there's just not as much land in any of our markets anymore, so really the product is going to pull the client, whether it's a tenant or a buyer, or is neighborhood still the primary objective?
Well, I mean, down here in Miami, the beach is the beach, and there's only so much beach. So you see different products popping up. I mean, we're in Surfside. Michael's more in South Beach. Gil's in Sunny Isles. But, you know, there's not that much beach, and there's not much availability to build new product on the beach. So, you know, then you bring in your brand, your architecture, and that's where people get really focused on the product. And at the end of the day, that's where you get the premiums.
Martin, with the political environment being what it is in the New York market, what are the opportunities in that space? Are you finding that there's an opportunity to navigate this drama and potentially find opportunities, or is it just doing what you're doing and kind of moving within the framework?
I think there's going to be a tremendous opportunity. I just think that no one really knows the timing around when that's going to happen. You know, obviously, the regulation around rent-regulated apartments is really what we're all talking about, you know, in New York, and I think there's going to be a tremendous opportunity long-term to buy those kind of assets that are 100% stabilized and underwritten properly with the proper taxes and the proper growth and all those kind of things. And if you can buy them at a 5.5 to 6 cap rate today with real expenses, there's a huge opportunity to buy real estate that I think over the next 20 to 30 years will be very, very valuable. How it becomes valuable is a little bit of an open question, but I think that there will be, you know, a change in the legislation in a positive way for us at some point. I just don't know if we really know exactly what the timeline around it is. And with financing today, you know, being able to borrow at 3%, you know, if you put the appropriate debt on your properties and you're not over-levering, and you can get positive leverage and start sitting onto something that clips a coupon of a 6-7% in New York City, I don't really know of a better investment, you know, personally, where I'd put my money.
I hear
And
it
to
is.
add,
Alex.
as a former New Yorker, you know, New York City still, you know, has huge transfer tax, and you know, as transactions become less and less, eventually people are going to realize, hey, wait a second, we may have made a mistake. So I think they're going to ease a lot of that regulation.
Yeah, I have to say, I mean, we cooperate with Knight Frank in developing the Wealth Report annually, and one of the things that always stands out to me is New York's presence in the top 100 most important cities in the world. Judging it from an investment perspective, and notwithstanding the net migration of about 400 people a day into Florida from New York, I still believe that New York remains one of the most important cities in the world, and I'm starting to hear rumblings of the same people that asked about opportunities in the South Florida market starting to ask about opportunities in the New York market. When's the right time to jump in? Because everybody still wants to have a place there, and I think both Alex and Michael have commented to me it's still one of the most incredible places in the world, so I'm not too concerned. I think that people will always recognize
New York's going to
New
be
York.
fine. I mean, look, just it's look at the numbers. You have 9 million people there, and that's not going to really change. I mean, yes, you're going to have 400 people a day moving down here, but I mean, there's always people wanting to move to New York, and you know, I can tell you, everybody that graduates from an Ivy League school, they're going to New York. You know, they're going to New York or San Francisco.
We talk about the evolution of Florida, and just being here at this convention and being out here at Trump Doral and watching Gil Dezer get stuck in traffic getting on his way here. How much does things like traffic and traffic patterns, how much are they affecting the buyers and the renters' decisions today? And similarly, although not directly related, what about sustainability and sea level rise in Florida? How does that affect you all? What are you doing to address it? And so 2 questions, sea level, sustainability, and then traffic.
So both things could have been avoided if this was held at the Trump International on the beach. There's no traffic in the residential areas. It's just, here in downtown Miami, right next to the airport and everything else.
Right.
But as far as sea level rise, everybody's paying attention to it, and we are required by FEMA and all kinds of codes to build to an adjusted sea level rise. I know in the ocean we can't build anything below, no habitable spaces below 16 feet, so 16 feet above sea level. So depending on how much is rising per year, I think we got about a couple hundred years until it gets to 16 feet. So I think we're okay.
Are any of you, look, there's lots of opinions on sea level rise, and people ask me all the time, is it having an impact on the buyers? Are they shying away from waterfront properties? And, quite candidly, they're not. Most of the big purchases that we're seeing here, whether they're condos or single-family homes, are directly on the water. People want accessibility by boats. They want that, call it billion-dollar view, and it doesn't seem to be affecting the decisions. But what are you doing? Like, I know, Michael, at Monad Terrace, you've gone to great lengths to develop a building that deals with sustainability and sea level.
Yeah, so I'll say a couple of things. First of all, people have a very short memory. So as an example, after Hurricane Sandy, prices dropped along the coastline very temporarily, and anybody who bought there did really well, because 6 months later, it's like, it never happened. I think Gil's right in that we have a lot of time, but you got to take it seriously. I think the biggest issues that are going to crop up around sea level rise is around insurance costs. I think, if the federal government one day just decides to subsidize flood insurance less, that slack's going to have to be picked up somewhere, and that's a little bit of a concern, but I think it's tolerable, and I think the market will figure it out. We're building a condominium on Biscayne Bay, which historically, South Beach had its issues with flooding before they embarked on a big infrastructure project for raising streets and pumps. We're at 11 feet above grade there. We have a garage that has a ramp that you have to kind of ramp up, then ramp back down. We did a complete soil mix. We built a bathtub. There are a lot of things we can do from an engineering perspective to mitigate that risk. I don't think it's in the buyers' minds very much. They might ask a question about it, but at the end of the day, people want that big view. They want to be on the water, and they want to enjoy the lifestyle. Even just from my perspective, if I need to leave one day a year because there's a hurricane warning, I'll leave and I'll come back, and it's not that big of a deal, honestly.
Yeah, I always say, Miami's the best place to live. Yes, we potentially get hurricanes, but you get a warning. You don't get a warning in LA when there's an earthquake.
Right. Fair enough.
And I just, I have to say, as it relates to hurricanes and sustainability, I think most people would agree that South Florida is the gold standard, at least for hurricane preparedness. And I think it's encouraging that we are leading not only the states but the world in hurricane preparedness and creating structures that really can withstand the worst of circumstances. But we're now starting to see government really engaging in all kinds of additional initiatives to try to create a sustainable environment, raising the street levels. In front of Michael's project on West Avenue, the street levels have been risen. So we are doing a lot to counter this, and I have to say I agree with you. I think that the globe is working together to find solutions, and I think ultimately most buyers are really not thinking about it as much as the people that are propagandizing the subject would like us to think. Florida is now the 3rd largest, most populous state in the U.S. with 22 million full-time residents. We're projected to grow by 4 million more residents by 2030, having an estimated 26 million residents. Where is everybody coming from, and what's driving them here? Anybody?
Listen, a lot of people are coming from the Northeast, obviously, salt, taxes, et cetera, but it's a big lifestyle factor too. By the way, you're seeing the same forces. People are leaving California and they're going to Texas, and people are leaving New Jersey, New York, Connecticut, and coming to Florida. There are a lot of factors.
If you look at this neighborhood here in Doral, in the last, 7-8 years, there's been a lot of South American immigration coming in here. This is known as Doralzuela, no? Because of all the Venezuelans that were running away from Chavez, and so they came to this area, built houses, and became permanent residents. So you have that in the southern part of Miami as part of a driver. I don't know if it's 4 million people over the next 10 years, but there's tons of wealth coming out of South America because it's becoming increasingly difficult and less safe to live there. And with EB-5 visas and us allowing people into the country a lot easier. It's facilitated those kind of buyers to move here.
With all these people coming here, whether it's the Carl Icahns of the world or the Barry Strongs of the world, we have to expect that the ancillary components of our communities will continue to evolve, whether it's arts or culture, education, dining, et cetera. How are any of you capitalizing on it? Are you getting involved in the non-residential space, trying to capitalize on where you see this economy moving, where you see this state growing? And similarly, how is that impacting other markets that you may be investing in? Anybody?
Well, I mean, culture is a foundation of any city, and so you're seeing a lot more cultural things happening here. I mean, you have Adrian Arts Center, you have American Airlines that's programming a ton of great things now. I mean, the Frost Museum, and that's just locally in South Beach. So the arts. I mean, I named my building Art Day because art is such an important element of people's lives today, and people can appreciate art from every price point. When you look at Wynwood, I mean, Wynwood's been driven by the art scene. And you have 2.5 million visitors going there every year, and that number is going to keep growing. People have been saying Wynwood prices are crazy, but Wynwood is really interesting because it's all driven by the art scene. So I think art is one of those incredible things that people have kept saying. It's the bubble's got to burst. The bubble's got to burst. But maybe at a 50 million price point. But artists and they just keep going and keep making more incredible things. And it's become part of real estate. It's become part of the culture. And you have great artists down here as well.
Go on, Martin. It's interesting. We talk about the evolution of our community and the different dynamics that are starting to develop here. And we see major institutions relocating here and major affiliations between hospitals, between educational institutions, and it continues to stimulate our market and create what I think is a snowball effect. So when we talk about a bubble, I think back to the days, and I remember Gil was very much involved in it, when the markets had 5 and 10 and 15% deposits, and all of a sudden the market dipped, and everybody walked away, leaving this surplus of inventories. That same very time when all the New York investors started calling us saying, hey, look, when can we pounce? Where's the opportunity? But do you all agree that today's market, at least in the state of Florida, is one that has sustainability, where it's driven by really strong fundamentals, this empty nester baby boomer generation that is relocating here instead of the flight capital coming out of Latin America, the investors being forced to place major deposits up on the products, the caliber of the product, projects like Arte and Monad Terrace, large floor plans, highly amenitized, low density units, or projects as significant as Porsche Tower and Armani. A little bit larger on the ocean, but still highly amenitized, larger floor plans. Is that a consistent shift in the dynamic of the Florida buyer profile, and do you think it's sustainable?
It's definitely sustainable. I mean, what we're doing now has been done already around the world. I'll never forget, I went on a trip to go see some buildings in Balneario Camboriú in Brazil. This place is like the end of the earth, okay? You can't even get there if you wanted to. And we got to the city, and there was a city that looked like Hong Kong. Hundreds and hundreds of buildings. And these buildings had more amenities than anything you see here in Miami. And we started saying to ourselves, we don't get it. Why? And so we started looking, and then, of course, when one developer does it, then the other guy, it becomes a game of outdoing each other. At the Porsche Tower, I put car racing simulators in there, and all my other condo towers in the neighborhood all have car racing simulators, even though they have nothing to do with cars. So it becomes one of these, trying to outdo each other. And so like at the Armani Casa, I'll be honest with you, we have a teen room, which is a billiard room, and then we have a kid room. Okay, so we have 2 rooms just to separate by age of children. So amenities is the way it's going, and since we are now moving the bar up, it's going to have to continue and continue.
Gil, are you going to continue to focus on condo development?
Yes. Yeah. We have 4 sites on the ocean. You were saying there's not more ocean left, but I got the last 4. So, so we have 4 sites on the ocean. And we have a huge project on the Intracoastal that we're about to kick off in the next 6 to 8 months.
And with the limited amount of land left, notwithstanding Gil's lots on the ocean, we're noticing a lot of movement north in the state and also west to the west coast of Florida. Do any of you have any interest in moving north, moving west, both for multifamily or condo development, or potentially any other type of investment? Are you seeing this trend of more and more wealth moving north in the state of Florida and across the state?
I'm open to looking at it. And I'll just say, to the point, it is a more stable environment. Like We did a condominium coming out of the last crash, Echo Aventura. We sold that entire building out with 50% deposits. We had no defaults. We just delivered a building called Echo Brickell relatively recently. We had a couple of, out of 160 units, we had a couple of people we needed to help with some financing, but we had no defaults. So it is a more stable, those buildings years ago, if the market would have faltered, we would have seen mass defaults. We really didn't see mass defaults. That's a tribute to the more stable deposit structure. I don't know what Gil's experienced on defaults in any of his buildings. There's some issues occasionally you have to work through, but it's not insurmountable and it's fine. It's a healthy market generally. So I do think it's healthier. And in terms of pursuing other markets, we're open-minded. We think that there's room to grow northwest.
Gil, are you seeing the same thing in your products?
Well, I mean, going back to that population growth and where it's happening, and we started buying in Orlando. Orlando has seen a huge population growth since the last hurricane in Puerto Rico. A lot of the Puerto Ricans have moved up to Orlando, and now they have their own kind of community there, which has grown substantially. So, I mean, Florida is Florida. Like you said, people are coming here for the weather and all kinds of other reasons, but it's not just Miami. They're coming everywhere.
And some people will be priced out of Miami, and that's okay too.
Orlando is still a market where you can build at a reasonable price for rental apartments, and we're right now doing 1,500 rental apartments there in Orlando.
We've seen prices escalate fairly significantly in the state of Florida, even though they've somewhat stabilized over the last year or two. What's driving this increase in pricing, both on a price per foot basis in the multifamily as well as the condo space? Is it construction costs? Is it land acquisition costs? Is it finance costs? I mean, what's the primary driver, or is it just opportunistic?
It's all the above. Construction costs never seems to come down much. Occasionally, it gets a little looser, but then quickly goes the other way. Construction costs have only risen. Taxes never seem to go down. If somebody can figure that out, it'd be helpful. So, I mean, and going back to New York, that's part of the problem with New York right now. If your rents are flat, your taxes keep going up, and your OpEx keep going up, that's a problem. So that needs to be figured out.
And what's really happening that nobody's talking to is everybody's trying to build to a monthly rent or an absolute price or whatever the case is. And what that just does is make the units a little bit smaller and smaller and smaller and smaller until everybody gets to that price. Eventually, the guy who's out there in the market who wants that new building, who's looking at that smaller unit, will realize he can get 60, 70% of a bigger apartment for the same amount in an older building. So then you start having to make that calculation.
Martin, are you shifting your floor plan sizes to cater to more smaller, efficient units, or is that kind of?
I mean, we've been doing that for 10 years. So, like, I think what you're describing has been going on in New York for a long time. But just listening to what everyone's talking about, the only thing that I would say is it sounds like there's a lot of product coming to the market. And just having watched what happened in New York on the condo side, there's going to be someone left holding the bag. It sounds like to me.
Interestingly, there really hasn't been a lot of condo supply the last couple of years in Florida, comparatively, as you know, because there just aren't a lot of new developments. There aren't a lot of developers who are capable of financing these things. So supply is actually not seeing a big bump. There's a lot of stuff. Very often things are announced and they don't actually happen. Gil's delivering building after building, but there's only one Gil. Right. There aren't five.
Well, there's one me, but I have competitors. But at the same time, what's good and bad is we're all in balance. The Jade was the one who just closed right next to us, right next to yours, and so they closed 90-some-odd%. They still have units for sale. Our Amani is closing next month, and we are today 87% sold. So assuming no major defaults, but we're still going to have inventory left. And so what does that mean? But at the same time, our outlook is we're not afraid of having that inventory because we see a big push of everybody coming to clean up that inventory very soon.
Yeah, it seems to be consistent. Most of the developers we're working at, who are financed by many of you in this room, recognize that this market is opportunistic, and at the same time you're hearing from Martin that the New York market still presents tremendous opportunity and is in many ways more advanced. Talking about financing, we hear a lot about the financing arena in South Florida and some of the challenges that we face in condo development. Are there any new dynamics in terms of financing? Has there any new opportunities opened up in the capital stack? I mean, do any of you have any opinion as it relates to financing and in today's environment, what the challenges are or where the opportunities might lie?
I mean, I think for all the lenders in the room, the opportunity is to give us more proceeds at a lower rate.
Especially if you're lending to Michael.
Yeah, that's it.
But there are
think
no
that,
new
I mean,
synergies.
what I'm seeing in, and I think it's probably happening here also, is that the debt funds are really becoming a lot more active and relevant in the space compared to traditional banks at very inexpensive rates. So I think that that's really feeding the condo market specifically on the construction side from what we're seeing. We opened up a lending platform about a year plus ago with the Carlyle Group, and we've put out almost $1 billion, and we're filling in that gap between where sort of the banks are. The banks are all pulling back to 55, 60% where they used to be 70, 75%, and there's a huge gap there. And there's an opportunity to sort of really capitalize on that if you want to be in that space. But often we're competing with debt funds that are borrowing at nothing and lending out at 300, 400 over. It's
and I think you
there's a
saw
lot
the
of
rise
margin.
of private equity getting into the debt space a few years ago, and now you're seeing a lot more developers, whether
Yeah.
they're on their own or partnering with debt funds, to give the debt funds expertise, on-the-ground expertise, and not be scared of stepping into the shoes if necessary. And you're really seeing a lot of developers stepping up and
I think the lack
filling
of,
in the gaps.
I think the lack of equity deals is leading all the private equity guys into the debt space, and the ability to sort of generate selling off A notes and all the kind of things that you do behind the scenes on the loan is generating returns that are equally interesting to equity returns, very honestly.
Yeah, I mean, it's definitely a major differentiator for our market when a developer starts building before they've sold the 50% of the product. It's a huge differentiator and usually leads to a successful project. In New York, as you all know, it's a different model altogether, right?
Right.
So it's definitely stimulated our market, the amount of debt that's coming into the market, and it's obviously following smart developers like, I know Michael, and I don't know about Alex, but it's definitely a differentiator. Well, I think we've covered some interesting subjects. I don't know if we have time to open it up to anyone for questions.
Chaz Eider from Marcus & Millichap, New Jersey. Can you give a two-part question? As far as New Jersey development, I know a lot has been talked about Florida. New Jersey development, what are your thoughts on New Jersey development? And the other part is, as far as the environment that we're in right now, in the real estate cycle, where do you see development and how are you hedging yourself against the future?
Anyone doing anything in New Jersey?
I can't speak
I
to
grew up
Jersey.
in Tenafly, New Jersey, and I haven't been back. That's all I can say about that.
So I think, by the way, the place that is most interesting to watch in the short term is Texas, because Texas, which has always been kind of a purple state, some of the big population centers, the cities, could turn and you could see Texas actually vote Democrat, which has really never happened, which is interesting to see. I think that that is more likely in Texas than Florida in the short term. But, it could happen, and it's something we have to watch. I don't really have a crystal ball on it, but it's definitely something that's interesting to watch and see what happens. Gil, you want to touch that one?
I mean, liberal voters is a problem everywhere. Speaking as a Republican, but so it's just if the problem grows, it's going to be that's a whole separate conversation. I don't think we should touch on that here.
You have a receptive crowd here, Gil.
ways that you're stepping in, maybe recapping, hookouts? Are you looking at those kind of opportunities yet?
I wouldn't say they started yet, those opportunities. They're starting to come around, people who can't get the financing, who need that kind of restructuring before they even start something. And then what we're seeing today is a lot of developers who started a pre-sale and then realize that they can't build to what they sold for. And so there's some of those issues going on. Some projects might not start or might have to re-up or do something a little bit different about how they're going to go forward. Those are the opportunities that we're seeing today.
And I think that, to Martin's point about the kind of lenders that are in the market today, a lot of these condo loans, particularly in the New York market, that the absorption's slow, they might be quote unquote in trouble. You haven't seen real distress because the debt funds are a little more pragmatic about reworking, and you're seeing kind of hybrid early inventory loans that, maybe the equity is a little impaired in some of these, but everybody's kind of so far been adults and have worked it out. You really haven't seen a lot of true distress. It might be coming, but so far the debt funds have been really pragmatic about reworking some of those loans to give runway, because everybody recognizes it's just going to take longer to sell some of that product.
I think in the next 18 to 24 months, you're going to see if there's real distress in the New York condo market, or there's just a repricing, a slight repricing versus a dramatic repricing. Because there is a lot of liquidity in the market, like what Michael was saying, to kick the can down the road for 18 to 24 months and give the developer the opportunity to sell out their product at a normal pace.
And I think you're going to find the inflection point where if you cut prices to X, things start to move. I don't think anyone really knows where that is yet, and I think you're going to see that in the next 6, 12 months.
So I have a question. Is it developer inventory that's going to cut, or is it resellers who are just developer inventory? So it's not people who, because all those sales at $5 to $10 million that were happening were all cash sales for the last so many years, right? So the inventory, the distressed inventory is not necessarily owned by the unit owners. It's owned by developers that may have it gone to their heads.
I think resellers will just hold. They'll just
You got to say
stagnate.
that. It's very important.
Yeah.
All right, well, thank you, Gil, Martin, Alex, Michael. Thank you all.